All right. Well, thank you everyone for coming tonight. So we, as kind of mentioned, a lot of our work at the Young India Policy Forum has kind of focused on Indian foreign policy, U.S.-India relations, and that has kind of been a theme of our events. Um, but right now, kind of given what we've been seeing with the Indian economy, so from the March, the April, May, June quarter, we saw a contraction of negative 23.9%. We've seen another contraction of negative 7% in the second quarter. And the government has been increasingly relying on the Reserve Bank of India to kind of provide momentum for the economy, both in terms of kind of fiscal stimulus, but also increasing liquidity within the system. And so with us today is Dr. Viral Acharya, who's the CV Starr Professor of Economics in the Department of Finance at NYU Stern School of Business. Dr. Acharya was the Deputy Governor of the Reserve Bank of India from January 2017 to July 2019, where he focused on monetary policy, financial markets, financial stability, and research. He is the author of The Quest for Restoring Financial Stability in India. We've sent around the information. I would highly suggest everyone buy it. It's a very fascinating read, especially for those of us who are very much new to monetary policy. But so given everything happening in India and also with some of the new RBI working group recommendations, our conversation today is very timely. So with that, I'd like to turn it over to Dr. Acharya to kind of give us a 20-minute presentation of his book and kind of where he sees India's financial system going. And then we'll open it up to Q&A. So Dr. Acharya, over to you. Dr. Acharya, you're muted.
Sorry. Thank you so much for inviting me, Akhil, and thank you to everyone who's able to join today, even in spite of this being in the evening. The book is really an attempt to summarize my learnings on the job as a deputy governor. Of course, it mainly consists of my speeches, which collectively I like to think of as a quest for restoring financial stability in India. There's a preface chapter called Fiscal Dominance, which I'll just explain what I mean by that. And at the cost of slight exaggeration, I call it a theory of everything in India. But I stress that it's only a slight exaggeration and not actually a substantial one. So my understanding of India during my term and a little bit from before and after is that India is basically becoming very fat in terms of its government. And that fat is now so large that it's beginning to crowd out the growth of the private sector. It's trampling upon the autonomy of various institutions of the economy. And essentially, it's leading to fairly large, very oftentimes sort of economy-wide blunders in policy making because everything has become very centralized in the economy. And the reason why fiscal dominance fits into that paradigm is because fiscal dominance is ultimately about this kind of approach of a fat government in a financial sense, essentially overpowering the autonomy of financial regulators and causing them to choose policies that are primarily focused on allowing the government to remain fat, so to speak. So in macroeconomics, fiscal dominance is thought of as essentially think of a government that has a lot of debt. It's going to face rollovers of these debts. The rollover costs may be a bit large because of the size of the government deficit. And fiscal dominance is when it overpowers the central bank and distracts the central bank away from focusing on its long-term goals, such as price stability or maintaining inflation at decent levels. And instead, the central bank says, you know, that fight is really in the long run. In the short run, I just have to help the government tide over its fiscal problems. So let me keep interest rates low. Let me buy more government bonds in the secondary markets. Let me print money and hand it over to the government for its expenditures in one way or the other, either to facilitate the government programs without a correction in its debt discipline, or to help the government roll over its debts so that it doesn't get immediately downgraded, and in the extreme case, it could be a point of default. Now, fiscal dominance is usually considered as problematic in macroeconomics because it essentially removes an important market discipline that exists on government borrowing programs, because the central bank steps in and alters the short run borrowing costs of the government. Of course, because it is getting distracted from inflation, if inflation impulses continue to remain in the economy, investors will rationally anticipate them, and the long term borrowing costs will not necessarily come down. And so you just get a palliative for the government in the short run, but its problems keep escalating. And now you have a double whammy after a few months or a few years, because actually inflation has been allowed to actually keep brewing in the background. And then ultimately, at some point, investors start uh, saying, listen, this is simply not credible. And invariably, what happens is that when this gets out of control, the central banks that had first actually kept interest rates low and adopted easy monetary policies to facilitate government borrowing then struggle to tell markets that no, now I am serious about controlling inflation. They, in fact, sometimes jack up interest rates by 5 percentage points in one decision, sometimes 10 percentage points, sometimes 20 percentage points. So I'm talking here about countries such as Argentina, where it has happened in the extreme. Sometimes it has happened in case of Brazil. Turkey is headed towards such a scenario as well. But essentially, it's not a stable macroeconomic scenario because the government is first spending too much. And then rather than reining that in and striking the right balance, it instead actually carries on with the support of the central bank. And the central bank in the process loses its credibility and commitment to its long run inflation mandate because it chooses to sidestep that in order to favor the short term interests of the government in rolling the debts over. Uh, in India, actually, the situation right now is in fact very similar. The central bank has actually monetized very, very large portions of the government debt. This is not something that has happened only post COVID, as in the developed economies. The monetization of government deficits in India has been happening even in the pre COVID phase. Especially in the 1 year before COVID, and the extent of surplus liquidity in the system is very large. And the big departure from developed economies where such policies are presently being adopted is that India's inflation is right now between 6 to 8% over all of last year. So, it is way above the central bank's own legally mandated target of 4%. It has a band of 2 to 6%, violation of which requires the governor, the chairman of the monetary policy, to give sort of a testimony to the parliament. And so essentially, the situation is right now comfortable, mainly because the global liquidity scenario is extremely benign. All governments and central banks are in an expansionary mode. They are incurring more government deficits. The central banks of developed economies are printing even more hard currencies, which are in one way or the other ending up in emerging markets because at present they have higher inflation, higher yields on government bonds, higher returns in terms of overall growth prospects, etc. And so the easy money is chasing the emerging markets, including India right now. And so, as of now, the fact that you have all these macroeconomic vulnerabilities is not at the present moment a source of huge concern. But when are these macroeconomic vulnerabilities a source of concern? That happens when the developed economy interest rates start rising, or when developed economy central banks start normalizing their balance sheets because they are beginning to reach their steady state growth levels. Inflation impulses are picking up, and they basically want to unwind the stimulus so that leverage excesses, leverage boom and bust cycles, etc., don't take force in the economy, and you don't allow inflation credibility of the central bank to be lost in the process by not correcting and normalizing in a timely manner. So the taper tantrum of 2013 was an episode where the Federal Reserve Chairman Ben Bernanke simply announced that we are going to begin the unwinding of our expansionary monetary policy. And that itself was sufficient for India to get caught up along with four other countries in a tailspin. The currency depreciated about 25% in less than 3 months. There were between 10 to $20 billion of outflows from the fixed income market in a very, very short period of time. The equity markets were didn't correct as much, but there were also significant corrections there because of the rapid depreciation of the currency at that point of time. Now, this is all about monetary policy. Most of my book is actually, it touches upon this, but it's also focused on the banking sector and the lack of resolution of the banking sector stress. And another form of fiscal dominance plays there, which is that the Reserve Bank of India is an all purpose central bank. It manages the deposit insurance through a subsidiary. It regulates and supervises the banking and the non banking system. It designs the rules for the government bond markets, in particular, including the currency markets. And it's also the debt manager for the government. So it runs the auctions for placing the government of India securities. So, and combine that with the fact that the government owns several institutions in the financial sector, notably public sector banks, public sector owned life insurance companies, government run pension funds, government run power finance companies. And when you take the combination of all this, what you observe in India is that fiscal dominance is limited in India not just to the monetary policy and the liquidity operations of the central bank. It pervades actually the entire apparatus for regulating the financial system, including the regulation of banks. So, a classic example is that loan losses in India are almost never recognized in time whenever they rise. The simple reason being that if the central bank marks the losses on public sector bank balance sheets, the government would require to inject more capital into these banks. If the government has to inject more capital, it would either have to undertake a greater borrowing and fiscal deficit, or it would have to stick to its fiscal norms, but then cut back on some other populist expenditures. Now, because it doesn't want to do that, what it does instead is to start dominating the central bank and essentially getting compromises in standards of when are bad loans recognized, are bad loans resolved, and then all of this starts combining with the fact that every sector in the economy now realizes that public sector banks are very reluctant to take losses. They will go and lobby with the government. The government will then lobby the central bank to relax the Basel norms for recognition of these non-performing assets. And so it reduces the credit discipline in the system as a whole, because every sector knows that when they need restructuring, they will get the restructuring by actually defaulting on banks, but banks will never be marking these assets as non-performing assets. So the borrower in the system is the real beneficiary of all this, because rogue borrowers, defaulted borrowers, can get away with murder in India without ever getting filed into bankruptcy court in a timely manner and their assets getting resolved in a timely manner. The cycle keeps repeating itself. As I describe in the book, we made a big push to get the cases into insolvency and bankruptcy court on the legacy assets that we had. However, a set of powerful firms, the fact that public sector banks were remaining undercapitalized, the government was fiscally stretched in 2018, an election year was coming up, so they wanted even the sick banks to lend rather than actually to repair them. And all of this meant that basically there were big headwinds on the efforts to restore financial stability in India. So, the sum total of what I observe in India is that essentially India's financial stability is intimately tied to the fiscal situation of the government. And that's because the fiscal situation implies that the government wants low interest rates, it wants a lot of easy liquidity in the economy, it wants public sector banks to be creating easy credit, especially around times of state and national level elections. And it wants that even if these banks are not in a great shape to lend, they don't have capital to undertake risks. And it wants them to do that even if these banks have in the past made spectacular losses and not yet improved their underwriting, monitoring, and collection technologies on these loans. So the structural reforms of the financial sector are the lowest in the priority of the government as far as reform agenda is concerned. And that's because they always want to have access to public sector banks. Why are Indian bond markets always relatively stable? Because the public insurance companies, the public sector owned insurance companies, and the public sector owned pension funds simply have to alter their allocations in favor of government bonds whenever the government needs to borrow more. Now, of course, sum total of all this, that banks are lending to the wrong corporations or they are excessively lending to the government. Insurance companies and pension funds have their allocations excessively focused on government bonds. The sum total of all this is that healthy borrowers in the economy don't have access to cheap funds. The only time they have access to cheap funds is when global liquidity conditions are completely flush with liquidity, the way we are right now. And if central banks basically turns a blind eye to inflation and continues to stimulate the economy as it is doing right now to deal with the COVID shock. Okay. Now, of course, these conditions may not remain because if inflation is actually running away in background, and by the way, it's not just food inflation in India that's high, even core inflation, which is doesn't include food and fuel, is also at very high levels. And one problem with fiscal deficits in India is that whenever these debt and deficit numbers are high, the government has to resort to very high fuel taxes. That's one way through which government of India actually substitutes for loss of tax revenues in a bad year. So the economy is already doing poorly in terms of growth, and the government is simultaneously raising fuel taxes and that creates an inflationary pressure through freight costs, costs of good produce, and that pushes into the retail inflation prices in one way or the other. So, to cut a long story short, what I'm trying to say in the book is that the government, the central bank, the banks, and the corporates in India, they need to strike the right balance. Right now, the system is moving towards India of 70s and 80s, which was a very centralized, nationalized economy in which the government played the massive role as far as the growth engine was concerned. The private sector was artificially kept very, very small. That trend changed in 90s and especially until the global financial crisis. So from the balance of payments crisis of India in early 90s to the global financial crisis in 2007-8, India actually embarked upon liberalization and divestment reforms. The government got out of a large number of sectors and allowed the private sector to come in. However, what has happened since the global financial crisis is that it has been hard to generate the same levels of growth as from 1991 until 2007. And successive governments in both sides of the current government and the opposition, or the previous government and the opposition, they have all resorted to essentially using financial sector as a way to create cheap credit and liquidity in the economy and create short-term boosts of growth instead of actually strengthening the economy structurally, improving the ease of doing business, undertaking reforms in land, labor, infrastructure, etc. Labor, they've just undertaken some reforms, but land reforms are not yet there. Infrastructure investments are really very low. Education and health don't get as much expenditure as is deserved. And instead, a lot of the government programs are focused either on populist distribution of subsidies or in meeting the salary and the pension payments of the huge number of employees which are absorbed and employed in relatively poor run, low productivity government owned enterprises. And basically we were in my view at the bottom in terms of the growth levels. India was generating just 3 to 3.5% growth for its potential. Then the growth got boosted to much higher levels, 7, 8, sometimes even 9, close to 9% growth rates during 1991 to 2007, 2008. Thereafter, however, the economy has been basically in fits and starts. The steady march towards maintaining 7, 8, 9% growth rate has become rather turbulent. Uh, Even pre-COVID, India's growth numbers had been successively dropping for several quarters, and many people fear now that India's potential output growth rate, unless the fiscal and the financial situation is fixed and some structural reforms are created instead to create growth, that India may be looking at a 5% steady growth rate. Post-COVID growth rates will be very sharp because the contraction has been very high. But the economy is still going to contract on a year-on-year basis for 12 months post-COVID. So from that point onwards, most people are projecting a much lower growth rate in the steady state unless the country gets its act together and fundamentally changes its engine for creating jobs, which is not so heavily centered in government trying to do too much, but instead is focused on government actually shrinking itself by reprioritizing what it spends on, which is mainly to provide public goods going forward rather than actually continuing to dole out subsidies and being present in large sectors of the economy with inefficient public run enterprises. So if it makes that switch, allows the private sector to blossom, of course, India's potential growth rate can be very high given its demographics and the ability to increase the per capita income, which can result in a huge consumption boost to the economy. So let me stop there and maybe I can take some specific questions if that makes sense, Akhil. But I wanted
Yeah,
to give a
absolutely.
broad macro sense of what I think is the trouble with India's growth model right now. And I think looking at the stock market, etc., sometimes gives a very misleading picture
Yeah.
because at the end of the day, if you look at the jobs which are getting created, it's not there. India needs to create
Right.
close to 1 million jobs a month, and it's nowhere close to doing that. A lot of people have dropped out of the employment workforce post COVID. Many of them have taken up the rural government guaranteed employment program, and that's providing a temporary assistance to these workers in the meantime. And one reason why the corporates have high earnings post COVID, especially in the last quarter, is precisely because they've slashed jobs and cut salaries. And that doesn't augur well for the growth of consumption and real wages in the economy going forward.
Well, thank you so much. I'm going to use my moderator's prerogative to ask a question first. If anyone in the audience has a question, please raise your hand, and then I'll call on you and unmute yourself. Um, so one question I had to begin with is that late in the book you make the point that rising government borrowings have the potential to crowd out the private sector, um, especially because kind of the main purchasers of government debt are the public sector banks. What are kind of the risks that you see here, especially given the immense GST revenue shortfall and the government continuously needing to go to the market to overcome that shortfall and borrow on behalf of the states, while at the same time saying that they don't need to actually increase their borrowings? So how do you kind of see this dynamic playing out? What are kind of the risks you see there? Could we see, as you kind of mentioned, a potential repeal of the corporate tax cuts that were passed last year, given the stressed fiscal situation?
Yeah, see, I was just looking at the numbers a few days back. The banking sector as a whole, right now, 30% of deposits are actually held in the form of government bonds of the central government and the state governments. So there's a huge nexus of the financial sector balance sheet with the sovereign balance sheet. Of course, partly this is reflected in the fact that credit growth as a whole is quite anemic because of the pre-COVID growth slowdown, lack of investments in the economy, as well as, of course, the post-COVID difficulties. Now, when you have this kind of nexus, and this is, by the way, a recurring theme on financial stability in my speeches in the book, which, if you want, I give examples of Europe in particular, where the periphery countries, their banks started loading up very heavily on the government bonds around the European sovereign debt crisis of 2009, 10, 11. And progressively, the sovereigns kept declining in their sovereign quality. And because these banks had been building up their exposure to the government, sometimes because they were simply gambling for resurrection, sometimes because there was moral suasion and they were asked to buy the government bonds in the auctions, whatever the reason be, ultimately it created a doom loop because the more the sovereign deteriorated, the more was the collateral damage on the balance sheet of banks. And the more banks started losing deposits, the greater was the perceived guarantee that the sovereign would have to honor. And the whole thing just went in a tailspin. And finally, the European Central Bank had to come out and basically do the quasi fiscal operations of backstopping Italy, backstopping Spain, and essentially keeping the euro together. But look at what has happened since then. Are the banks in the periphery countries fixed? No. Is the Italian debt to GDP at any better level than what it was at the time of the European sovereign debt crisis? No. So most likely, the scenario that you have laid out is likely to play out in India in the following way, which is that because inflation is high, at some point when the world is not willing to keep buying India's government paper at any price, because the foreign interest rates are so low, or when domestically investors realize that inflation is not actually coming down, and that's the real risk I see right now, the long end of the bond yields will start rising because it will not be possible for the central bank to simply keep anchoring inflation down without actually taking corrective steps in order to make that happen. So if the central bank doesn't actually take corrective steps and instead is actually continuing to accommodate because it is fiscally dominated in helping the government roll over the deficits in the short run, the long end will start rising. That will create collateral damage on the balance sheet of the banks. The central bank will do the normal thing that the bank regulators do, which is to say, no, you don't have to record the losses. Don't record mark to market losses. You can postpone them, recognize them 2, 3 years down the line. But the market knows. I know that Indian banks have 30% of their deposits in government bonds. So the market value of the banks will start showing stress. That will then create stress in the interbank markets. The central bank can keep trying to fight all these fires one after the other, but ultimately the real situation is that the banking sector will become undercapitalized because of losses on its treasury positions, because the quality of the sovereign bonds will decline. And when that happens, they won't be in a position to lend to anyone. Even if the central bank says go and lend, they will say, I'm sorry, I don't have risk capacity because I'm still absorbing the losses. In fact, what I need to do right now is to not have more non-performing loans. So I would rather evergreen my distressed borrowers. I would rather extend and pretend the maturities of zombie firms so that they don't show up as non-performing loans on my balance sheet. So in my view, the toxic combination of high government deficit, high bond holdings of government debt by undercapitalized banks in India, a rising inflation, and slowing growth, not just post COVID, but also pre COVID. I think these are setting up very, very difficult conditions that we have seen historically affect even developed countries. And there is no easy way out other than to actually try and resolve the imbalances ahead of time, because otherwise you are just fighting fires. And you can fight fires. Central banks have huge balance sheets that can allow them to take over the risks, but just taking over the risks from the system doesn't mean that other players will simply go out and start investing in the economy and start growing well all over again. And I think Europe is a classic case in this, where the periphery developed countries sovereign debt got entangled with the banks, and it still doesn't have a resolution of this problem. And when you don't resolve these problems quickly, of course, another shock comes and hits you. So India hasn't resolved its legacy loan problems from 2009 to 2012. And of course, COVID has now hit, and that's likely to materialize in more losses on industrial and consumer loans over the next 12 months.
Well, let me ask you kind of the follow-up question on that about kind of the bank balance sheets. Because as you kind of pointed out, is that India hasn't kind of address the legacy loan issues of 2008, 2009, and those repercussions are still kind of being felt across kind of the banking system. And the government has kind of been, in the past couple of budgets, it's been very tepid about its desire to kind of recapitalize the banks, instead opting for kind of consolidation of the banks. And the idea of a bad bank continues to kind of pop up in kind of the Indian press, kind of in the lexicon of uh, a potential way to resolve these issues. Um, but right now, it kind of seems that instead of kind of recapitalizing the banks or letting the banks be, the government seems to be relying more and more on monetary policy to kind of saying that the non-performing assets in the system right now are are not as high as they were in 2008, 2009. There's enough liquidity in the system to cover all the non-performing assets, stimulate growth, and kind of keep inflation in check. But that doesn't seem to be the case. What are kind of the challenges and risks that you see there? And could we see, like as we saw with LVB recently, could we see kind of more public sector banks fail and be taken over by the private sector? And just to transition very quickly on kind of that working paper, the working group paper that you and Dr. Rajan had quite scathing remarks on, is there a possibility that the government is trying to allow corporates into the banking sector in order to kind of take over the public sector assets as it focuses on consolidation of the public sector bank?
Yes. See, the idea of bad bank has been there for a while. See, to develop a bad bank, create confidence that it will have the ability to take over the bad loans from the banking system and then resolve these assets in the bankruptcy code. You need it to be professionally managed. You need sort of investment managers who have the expertise to figure out at what prices to buy these loans and then how to actually resolve them in bankruptcy. So it's asking quite a bit of the government and the state. It should have the capacity to actually design and set up such an institution. Of course, it will need funds to buy these loans off the bank books. So to provide those funds, the government will, instead of recapitalizing public sector banks, it will have to put up some money as capital into the bad bank, even if it goes out and then levers up that money in the markets. No one's going to give you that leverage unless the government has committed some capital into the bad bank. The big problem that arises in India is at what price should the loans be sold? See, because if the bad bank is government owned, there will be whoever is in charge of this will be subject to the scrutiny of the government offices. That's the the Central CBI, the Central Bureau of Investigations, the Enforcement Directorate, etc., etc. And they will not be comfortable about buying the loans, therefore, at throwaway prices in order to help the public sector banks look good. So what you need is objective benchmarks for these loans. And in India, unlike in, say, United States or South Korea, we don't have markets for these loans in the secondary market. The loans are not adequately standardized. Even when they are standardized, the loan documents are not transparent. They are not available in a registry for everyone to see. So the due diligence of the loans is not that easy. In fact, when banks in India try to sell loans, they are done through very quiet, sealed bid kind of auctions. No one actually knows at what bids were submitted. Ultimately, if they were rejected, were they too low? Or it's just that the bank really wants the moon, even for a non-performing loan, because it doesn't want to write down its capital. So I think bottom line is that the idea of a bad bank theoretically makes sense. It requires certain capacity, financial as well as execution capacity on part of the government to find professional investment managers. I think all that can be done, but I do think that ultimately you need some transparent benchmarks which can be used as reference prices around which these loans will get sold from the banks to the bad bank. Because without those objective references, the market will remain broken down because there's a risk aversion about doing these transactions. If some public servant, either at the public sector bank or at the bad bank, fears that ultimately they may get hauled up down the line for having used government money not at the right price. Now, it's a bit silly in case of a government owned bad bank because the money is just going from one pocket of the government to public sector banks. But see, some of the loans will have private banks also in the consortium. And therefore, I think this issue is not as simple as money just flowing from one pocket to another. Now, what is the end game? No one really knows because the government refuses to provide a blueprint. As far as I can tell, so far the government wants to show activity, that it's doing something. And the bank mergers are an exercise in that, in my view. They keep the public sector banks busy. They have to integrate their operating systems, IT systems, loan records. They have to consolidate branches. So suddenly a flurry of activity happens, but it doesn't change the economic size of the public sector banking. It doesn't fundamentally change their non-performing loans problem. It does reduce the number of appointments the government needs to make. Sometimes it reduces the coordination problem in the resolution of bankruptcies because there are fewer bankers sitting on the table to agree on a restructuring package. So there are some advantages, but I don't think it's a game changer at the end of the day. Now, will the public sector banks get weak to a point where they fail? I don't think so. The public sector banks will fail when the sovereign solvency is itself in concern. So in the book, I use the term silent crisis. India, China, and countries which have very high presence of state-owned banks, they go through what I call a silent crisis. Banks that are owned by the government don't fail. Depositors actually trust them. They have very high level of safety perception in these deposits. But that doesn't mean they are not having a crisis because we care about a financial crisis only because it affects the real economy. So if a bank doesn't fail, and yet the real economy is crippled because they are not lending well to the real economy, it's as good as having a silent crisis. It's not a violent one where depositors are pulling out and disintermediating the bank balance sheet altogether. Nevertheless, it has significant welfare costs. So, what is the trigger for this kind of solvency concern at the sovereign level? That's hard to know. It could be inflation. It could be just mounting levels of government debt and financial repression that could be associated with it. It could be an external trigger. As I was saying, what is the problem with fiscal dominance? It creates a macro situation of high vulnerability, high government deficits, poor banking system, low credit growth, low growth, high inflation. All of these were exactly our macro conditions at the time of 2013 when the taper tantrum took place because of the Federal Reserve announcement of likely beginning of normalization of its balance sheet. So an external shock can also trigger this kind of a reaction, both because of the implicit guarantee that the sovereign has on the public sector banks and because of the high government bond holdings of public sector banks in India. I think the collateral damage of the fiscal concerns onto the banking system will be very hard, and there could be a downward loop that arises as a result of that.
Excellent. Vash, did you have a question?
Yes. Hello, Dr. Acharya. So, the literature sort of says that India has been able to avoid a original sin crisis because it has created this sort of self-funding loop by owning the pension funds, not pension funds, I meant life insurance companies. It owns the banks, and it's able to fund itself in its own currency, and so it doesn't have to have an external currency crisis. Would a significant privatization of India's banking sector allow India to have that kind of autonomy that it has so far achieved, or would it then be subjected to the classic EM crisis of foreign currencies?
See, there's something worse than the original sin or the classic EM crisis, which is a long stretch of financial repression by the government. What you described, which is that the public sector banks, life insurance companies, pension funds are basically just gobbling up government bonds at every auction. This means they are not actually lending to the healthy borrowers in the economy at reasonable costs. Their favored borrowers are either the government, center, state, or the government owned enterprises, or their favored borrowers are the zombie firms because they don't want to recognize the losses. The whole middle tier of healthy borrowers in India has historically paid very, very high costs and in fact also got quantity rationed in their borrowing limits. So there is something worse than the original sin, which is that you could have a period of zombification of the economy, very high financial repression, economic stagnation, lack of private sector investment, lack of private sector credit growth, low productivity, and the government keeps getting fatter and fatter, and the private sector keeps getting smaller and smaller. Does that necessarily lead to a sovereign debt problem for a while? No, because all the savings in the economy just get channeled to one borrower, which in one way or the other is ultimately the government. In fact, in the book, I have a final essay, which was my last speech delivered as a deputy governor. It was on crowding out, which is how there is evidence in the Indian corporate lending and bond markets that the size of the government debt through the ownership by banks, insurance companies, etc., is basically crowding out the private sector's borrowing capacity and growth in the Indian economy. In contrast, and why do I say that it is worse than actually the original sin? Because India did reach a balance of payments crisis in early 91, but look at what that brought about. Ultimately, it brought about the right structural changes. It liberalized the economy. It produced a wave of divestments, notably during 98 to 2003. But sometimes these kinds of crises, if they are used as an opportunity to fix the underlying imbalances, function much better for the economy in the long run, even if they are painful for the government at that time. Whereas, if you want to be zombified or Japanified for a long period of time, it can work out very well, but that comes at very serious costs of potential output that is lost along the way.
If you don't mind, I have a follow-up question.
Yeah, in fact, if I could
So,
just say one thing, which is kind
yeah.
of just because it's a kind of a little light. The book has a wonderful foreword by Dr. Y.V. Reddy, who's the former governor of the Reserve Bank of India, and he describes the situation of the Indian government in 70s and 80s exactly the way you described, which is that everyone is just buying government bonds. The central bank funds government expenditures, public sector banks, whatever deposits they get, 30 to 40% are being used to buy government bonds or loans to government-owned companies, etc. And so he calls this arrangement between the government, the banks, and the public sector banks as a Hindu undivided family in which no one kept anyone's proper accounts. But that only delivered what was called as the Hindu rate of growth, which was 3 to 3.5%, and it ended with the balance of payments crisis for India. So while he's being very witty when he says it, I think the reason why he's saying it in his foreword is because he fears that India is moving again in that direction of becoming a Hindu undivided family between the government, the central bank, and the public sector firms in the financial sector.
Thank
Yeah,
you.
sorry, you had a
So,
follow-up question. Yeah.
yeah, my follow-up question was, so I've noticed that because the healthy middle sector isn't able to get funds from Indian public sector banks, they've been allowed to do external commercial borrowing, and the RBI has loosened the norms successively. Now they can borrow for working capital. And is that creating any sort of dollar risk in India, where a lot of Indian private companies have now gobbled up on dollar debt and then have to pay back in rupees?
Yeah, see, that is basically the classic trade-off that the RBI faces, which is that, these firms are getting crowded out in the domestic markets because the government is dissaving more than the net savings of the economy. So on the margin, corporates have to get finance from outside. So that's the call RBI has to constantly keep taking. How much to allow of this borrowing? At what point, if there's an external shock, will the borrowings of these companies actually result in liquidations and a run uh, or a scramble for dollars to repay the debts? The corporate debt did not turn out to be the dog that barked during the taper tantrum. It was actually more the holdings of treasury bills and the commercial paper, which has now been banned because you have to invest in longer maturity securities if you are investing from abroad. But external commercial borrowings have grown to be very large. The maturity has shortened, especially if it starts getting used for working capital. Then you have a problem because that tends to have relatively short maturity. and then a period of volatility can result in a very serious scramble for dollars. Now, on the flip side is that the central bank has actually built up a very big war chest of reserves. I think it is now at its historic high. I think it's more than $560 billion, I understand. The post-COVID flows, of course, in March, end of March, there were massive withdrawals out from India, like in other emerging markets. But once the central banks came in, stabilized, provided swap line facilities to other central banks from Federal Reserve to others for dollars, actually flows in India have been actually one of the best in the recent years. And, I think one should not take that for granted. And this is why I keep stressing the point of overall macro resilience and vulnerability, because external shocks don't come with prior notice. They come as surprises. They can get triggered by interest rate hikes here. They can get triggered by normalization of balance sheets in the US. They can get triggered by a sovereign default in other parts of the emerging markets, creating some kind of a risk aversion towards emerging markets. Now, maybe in the next 6 to 9 months, it's extremely unlikely that until the world is vaccinated reasonably and economies start coming out of post-COVID phase with some stable growth rates, that central banks won't normalize. But because the macro vulnerabilities are large, fixing them is also going to take time. If you want to be in a good position in 2 to 3 years' time, then perhaps such a shock might materialize because there's normalization in the developed economies. I think India has to start the work now. It can't just take it for granted that this money that's gushing into the economy right now and relaxing the financial constraints for everyone, because there's just so much liquidity. The at short term in India, corporates are borrowing below the central bank's reverse repo rate. So actually, there is so much liquidity floating, and the central bank has decided that it's just going to let the interest rates go even below the floor. So inflation in India is right now close to 7.5%, and the short-term money rates in India are below 3%. Okay, so that's a huge negative real yield on fixed income securities that is getting engineered through this high levels of liquidity. And in my view, this is precisely the reason why you talk to anyone in India, their neighbor, and they themselves, if they have not yet invested, they want to invest in the stock market. Because India is a closed economy. They can't just take this money out and try to earn higher yields somewhere else. So given that fixed income securities are giving such negative yields, real estate as an asset class is not doing well, though there have been some stamp duty reductions which are encouraging real estate investment. The only other option is gold and stock markets. Those are the only options they have to look for high yield. And so I'm a bit worried that the Indian stock market valuations are very, very frothy. They look quite distant from the reality on the ground. And that this is partly because of the very easy liquidity and the search for extra yield and return that it has created in the Indian households. So maybe some of this is what the rest of the world is doing as well. But I keep stressing that India's fiscal, financial, and inflationary situation is far different than that of developed economies. And that cannot be ignored. So you can't just adopt a toolkit from another set of countries and carry it over to yours, because your initial conditions are very, very different than of these developed countries. All developed countries have their inflation below their target levels of inflation. Whereas in India, it's not just above the target level of inflation, it's actually above the band around the target level of inflation. So I think there's one more question.
Yeah, actually, there are a few questions in the queue. Savash, let's hold off for the moment. I think Hari had a question next, and I'm going to ask everyone to kind of consolidate. So let me go to Hari, Kriti, and Akriti.
Yeah, and I'll also try and give brief answers so we can get to all the questions going forward.
Sure. So Hari, go ahead.
Hi, Dr. Acharya. Thank you for a really fascinating talk. A lot of your talk focused on like the fiscal dominance of the government and how the RBI's role ends up being supporting that fiscal dominance. Well, let's say we are able to get those like structural reforms that are necessary to like reduce the role of the government in the economy. What do you think the role of the RBI should be in like a more balanced economy to guarantee India's growth? Like, would you see a long-term reform in a way like changing the role of the RBI to be something like the Federal Reserve in America, where it has like a dual mandate, or what would you suggest?
Sorry, Dr. Acharya. Let me ask Akriti to ask her question, because I think it follows on nicely with Hari's question.
Yes.
Thank you so much, Dr. Acharya, for your time and for your comments today. So I want to ask a question that it's small and sounds simple, but I'm sure is really difficult to answer. But I wanted to ask, what's the future of some of the reforms that you were talking about in India? You mentioned, land reforms, tax reforms, but as we've seen with the farm reform protests, that a lot of times these reforms are very difficult and political, even when you try to use a crisis as an opportunity. So just your comments on that.
So just let me start with the second question. Reforms are possible in India. Of course, there's resistance. Part of the issue is how they are pushed through, whether consensus has been built or not. Agriculture in India has always been a state level subject. And this time there is a very important centrally driven farm bill that was pushed. I'm actually with the specific reforms that are being implemented. It's very clear that the middlemen or the wholesalers were getting all the benefits of procurement of food grains at the minimum support prices, etc. And the end farmers were not actually benefiting much from price competition. And very often these wholesalers are hand in glove with the local governments, either municipalities or the state governments. And so, the small farmer in the end was never really actually getting the support that the government was providing. It was all getting eaten up by the larger farmers and the aggregators in the economy. But I think there is this issue of how you deliver the reforms. Are they delivered based on some consensus building? Are they delivered by bringing other people to the table? And Punjab and Haryana are the largest beneficiaries of the minimum support prices, because they are mostly provided for rice and wheat, where India has huge production. India has huge stockpiles of these grains, given our level of consumption of these items. And so just like if you were to be a political strategist, you should have expected some resistance of these type. Now, should they have been brought to the table and then discussions should have gone forward? I don't know. Some people say it would have been a non-starter. In that case, the farm bill would have been a non-starter, so to speak. But this remains a challenge. The government actually so far has stuck to its bill. There are some rumors that some compromises are being agreed upon. But I think sometimes it's a matter of the optics and the consensus building aspect of it, which I think sometimes make reforms successful, in my view. I think there will be a challenge even in reforming public sector banks. The biggest opposition to reforming public sector banks is from the public sector bankers. They have cushy jobs. Middle class in India always doesn't like anything that I put out to reform public sector banks, because they want their youth to have the job security of these highly unproductive jobs that are being funded with taxpayer money. So, you need to change that. You need to make it clear to these employees of public sector banks that, listen, they will actually have a brighter upside. And I think that is gradually happening. Some of the private banks have done so well, and those who had joined private banks have such more flourishing careers, even at the middle tier of banking managers compared to the public sector banks, that people are realizing, which is, I'll just be very frank here. My brother works for Air India. And, would he have liked during the course of his time to have continued to have just the job security of Air India? Or would he have liked to be in private sector airlines? I think I don't know his answer, but I'm saying that's a question everyone has to ask. When the government deficits are so large, Air India is making such large losses, is it clear that people in India increasingly want just the public sector enterprise job? Now, of course, if you keep the private sector smaller and smaller and smaller, there are no jobs left other than government jobs, and that becomes the aspiration of the youth. And that is the fear that I have from India getting centralized, nationalized, and the government getting fatter and fatter. So to cut a long story short, what I'm saying is I think the capacity for reforms is there, but I think the reforms have to be marketed. The reforms have to be built some consensus around. There are always some key bottlenecks and sort of lobbyists that may block every key reform. Sometimes you may have to muscle it over them. But that's part of, I think, what happens in a democracy, in my view. I think the key problem in India, a variant of this centralization problem, is that states are increasingly not being brought on board with what the center does. And I think just the way India needs more privatization, India actually also needs more decentralization of decision making. Because I think what happens is they want to deliver everything through the center because that helps the branding of the party, that helps the branding of the government, that helps the overall way in which the popularity of the party has been created. And if I can just be more explicit, every subsidy program has a billboard at a petrol pump that basically has the prime minister's picture on it, because that's the branding that the party does. Now it's the state that in the end has the machinery to deliver the subsidy. But what happens is everything is getting marketed in India as though it is the center's program. And I think this is a big problem because India is a cooperative federalist system. The center and the states have to work together. Right now there was the whole disagreement on the goods and services tax, because when the collections are low, the center is supposed to borrow in the bond market and make up for the lost transfers of the GST to the states. But the center, after having provided this commitment to the states who signed off on the GST tax, was almost about to default on that. And finally, Vice Council has prevailed, and partly through their own borrowing and partly through RBI facilitating the borrowing of the states, at least that situation, which had reached a boiling point, has been averted. But my overall, what I'm trying to say is that I think the reforms, if they are delivered in the decentralized manner, might have a greater chance of success rather than being pushed as the muscular will of the center, I think. Coming to the point of Hari, which was, I'm trying to now remember what the question was.
About how you would want the role of the RBI.
Oh, yes. See, the problem in India is that we don't measure employment very well at a high frequency. So it's hard to give a dual mandate that's tied to employment. So the best you can have is what the inflation targeting central bank has right now, which is it's targeting inflation while paying attention to growth. Most people argue that right now, the entire model is a bit reversed, which is that the primary attention is on growth and inflation is actually getting sidetracked. Now, whether it's getting sidetracked because of growth or whether it's because of fiscal dominance, we can have a debate about that situation. I think what RBI should do, in my view, is what it is legally required to do. RBI is not run by elected officials of people. RBI is run by technocrats. RBI is or run by bureaucrats. And I think they have to fulfill what the constitutional mandate of the RBI is, which is to protect depositor interests, to provide financial inclusion, to target inflation at 4% while paying attention to growth, and to run a healthy banking system at the end of the day. I think, to me, that is the most important job of the central bank. I think of the central bank as the heart of an economy, the banks as the arteries through which the liquidity gets pumped to different organs of the economy. And if the body is not maintaining its arteries in a declogged manner, the heart is not going to be able to pump blood to the organs. And I think that's with a little bit of a stretch of an analogy, I think that's India's problem right now, that the financial system is sick. It is not actually carrying blood to its potentially healthy organs. And gradually they are also, as a result of that, beginning to not achieve their growth potential and feeling a silent atrophy of what they could be.
Dr. Acharya, I know we're at 10, but we do have one more question.
Okay, let's take one last question. If that's okay. Yeah.
Sure. So let me go over to Kriti Upadhyay to ask her question.
Hi, Doctor. It's great to listen to you. I had actually two questions, but I'll keep it super quick and just have one question for you. We spoke a little bit about NPAs, and with the IBC right now suspended, what's your take on this? How much of it is actually helping corporates get relief, and how much of it is just kicking the can down the road? And what do you see the outlook once things are back to normal after COVID and the IBC is back in place? Thank you, sir.
Yes. See, part of the problem is, of course, the suspension of IBC. Some people are justifying that by saying that, how can you have productive enterprises be put into bankruptcy during this period? Well and good. My point has been rather simple, which is that if you want to provide relief to these corporates, and in fact, it's not just that the corporates are not being filed in bankruptcy, they are actually going to be allowed to restructure their debts without a proper accounting of the loss that the bank has incurred in a timely manner. The losses are going to be spread out on the bank balance sheets over a 4-5 year period. And that is what I'm most worried about, which is that if it makes sense to give relief to the corporates, you have to put capital into the banking system to absorb the loss. Now, in case of public sector banks, the government has to foot the bill. In case of most private banks, there is surplus capital that can absorb that loss. Now, why are the losses not being marked quickly? Because the government doesn't want to actually put out the recapitalization funds into these banks in a timely manner. Now, if you don't put recapitalization funds into the banks in a timely manner, when the economy is trying to rebound, banks will be risk averse because they don't have actually enough growth capital to undertake risky credit decisions. They are going to continue to lend to the defaulted firms that might get recognized as non-performing loans as and when the IPC opens, or they will continue buying government bonds as we are talking about. So I think at the end of the day, the financial sector problem, besides the overall skill, expertise, and risk management capacity of the public sector banks, is also an issue of capital, which is that we keep giving restructuring relief to borrowers without absorbing the losses onto the banking system and providing for these losses. I'll just give you one final example, which I stress a lot in the book. Over the last 5 years, once every year, at least once every year, there has been a restructuring package for small, micro, and medium-sized enterprises. Okay, this sector is structurally not able to be globally competitive anymore. Why have Indian textiles not done as well as in the neighboring countries? Because they don't have the ease of doing business, they don't have the productivity, they don't have the scale in order to compete with our neighbors who have actually now created so many jobs out of that one sector. India's textile small, micro, medium-sized enterprises keep getting a restructuring relief every year. They get money from the banks, they don't pay, the loans are restructured, and they are never recognized as non-performing assets. Now, when you do this 5 years in a row, at some point you lose a sense of what the balance sheet of the bank is, because you have just so much catch up to do. And my worry is that the losses are going to be substantial over the next 12 to 18 months, not just from corporates, even the consumer loans in India, which I think is going to be the biggest hit, because what has been the biggest loss during the COVID phase? It's of services. Those who had to pay their rents have not been able to pay their rents. They have been postponed. I was just talking to my undergrad friend yesterday in a Zoom session, and he said, listen, his barber, who was relatively prominent barber in the town of Bhopal in Madhya Pradesh, he said he has not been able to pay rent. So his scenario is that in 12 months' time, even when the business comes back, he's going to have huge debts that are going to have mounted as a result of these rental payments. Now, it might make sense to give relief to him, but then you have to absorb the losses on the bank's balance sheet, because the bank then has to be able to continue to lend to other firms in the economy. So we are never completing that last step of actually fixing the banks. The debt contract in India looks like an equity contract. When you can't pay on it, you just dump a loss on your financier and you continue operations as though nothing has happened. And that's why debt in India recovers on average 20 to 40 paisa on a rupee. In most parts of the world, you would get 70 to 90 cents on a dollar on your debt. In India, the recovery is very low because the governance of the debt contract, the way it is resolved, the way the banks actually pursue the losses has meant that it's basically credit is easy to create. It's often pushed through the government fiscal stimuli, or it is pushed through quotas being set for lending to individuals or MSMEs, etc., around times such as COVID. But we don't have the discipline to enforce these contracts when the time comes due. Or if you have a shock that deserves restructuring, we don't fix the banks. And therefore, I'm worried that what is happening right now is a classic kicking the can down the road, as you put it, which is what we are seeing right now. And this is going to be the Achilles heel for recovery, as it has over the last 5 years. The primary problem with India over the last 5 years has been an underperforming banking and financial system. And we just don't seem to accept that. We don't acknowledge that this is a problem. We need to put financial sector reform at the top. But somehow there is this, everyone is looking for miracles, that because we have now given production linked incentives, because we have passed a farm bill, because we have passed labor bills, suddenly India will become a great economy. But no, a great economy needs a great financial sector. The arteries need to be carrying blood to the organs of the body in the right capacity. Otherwise, you can't support your growth without a healthy finance backing it. But let's see. I'm still hopeful that some reforms do happen also in the financial sector, while they are happening in some other parts of the economy.
Well, Dr. Acharya, I just wanted to say thank you on behalf of all of us. This was a very fantastic conversation, and there are still a lot more questions, but I promised to let you go at 7, and we're a bit over time.
Yes,
if it's all right
no
with
worries.
you, I might send you an email with some of the follow-up questions.
Sure. Yeah. Whenever I get a chance, I'll try and type in some responses. Sure,
absolutely.
No
well, thank you so much once again. This was very informative, and it's such a delight to be able to speak to you. So again, from all of us at the Young India Policy Forum, thank you very much for taking the time to speak with us tonight.
No, thank you, and take care. Be safe.
Thank you so much, Dr. Acharya. Have a good evening.
Thank you. Bye.